Hello and welcome to the lecture for Chapter 6, which deals with budgeting. So most of you have worked in organizations that have budgets. Most organizations have budgets. All of the organizations I've worked for in the past have certainly had budgets. And if I look back on that, I would say that many of them didn't do as good a job as they could have done in retrospect. And their budgets either caused behavior that wasn't consistent with what was best for the company, or didn't get all of the advantage that should have been gained based on the effort that was put forward in the process. So I'm going to talk a little bit about the practical issues within budgeting, talk about some of the problems that arise, and then talk about an approach. I'll end with an approach that I think solves some of those. The book talks about two different things that I want to just be clear about to begin with. They talk about decision management versus decision control, and that's not something that is part of your normal vocabulary probably. So decision management they're talking about there is deciding what what we're going to spend money on. So what are we going to buy, what machinery, what employees are we going to hire, all of those kinds of things. Decision control is the process of saying, did you spend money on what you were supposed to spend money on? So those two things is decision management is the initiation of it, control is an after the fact, did you do it or not? So I like to think of budgets as really, again, as it says here, it's a forecast of all of the financial transactions that we believe are going to take place in a future time period, usually a year or split into monthly buckets. But it's also a communication tool. So it's a way for management to communicate what their goals and targets are down to the rest of the organization. It's a way for the lower levels of the organization to communicate up to management what kind of resources they'll require to do the job that's being asked of them. And then those are both directions vertically. And then if you think about it horizontally, it's a way for different parts of the company to know what other parts of the company are doing so that they can hopefully act in a coordinated fashion. If I'm in production, I want to know what R&D is working on with regard to prototypes, so I need to know when I need to have my production ready, that sort of thing. So decision rights are the resources that are available to the manager based on the budget being approved, and then performance evaluation is, did you spend within the budget or did you overspend the budget? And that can lead to promotions and it can lead to terminations, so it can be very important in a lot of organizations. The one thing the book doesn't talk about that I think is worth mentioning, because this, if I have to say one thing that most companies don't do very well with regard to budgeting, it's this. It should start with the strategic plan for a company. And the strategic plan should be consistent with the company's mission. So I've given an example here so that the hierarchy is the mission. What business are we in? Why do we exist as a company? That should influence our strategic plan. The strategic plan is, where do we want to go? Where do we want to end up? Where we want to end up is going to influence what kind of actions need to be taken to get us from where we are today to where we want to be. The actions in the upcoming 12 months should influence our budget, because we're going to need to spend money on those things to do them. So as an example, I think I may have used a picnic table company before in this class, I'm not sure. But if I have a picnic table company, my overall company mission might be to improve outdoor living, right? Make people more comfortable in their outdoor space in their home. So part of my strategic plan might be to launch a new line of sustainable outdoor furniture. I want to expand my product range to include that. So I'm going to have an action plan that might be hundreds of items that I need to do in order to reach that end point of launching that new product line. One example of an action would be, I have to hire engineering staff to design that furniture. Okay, that's going to be brought to life in the budget by me having a line item in my budget that increases salaries for engineers by $10,000 per month in a certain month. Okay, that's going to indicate that starting April 1st or starting July 1st, I can add that staff in order to be able to do that. So there's a direct link here between the long-term strategic plan of where the company wants to go and what is in the budget. That to me is very important. So here's an example from your textbook of a budget report. So this is comparing actual spending in the month of September with the budget for the month of September that had already been approved. So this is at the highest level. This is for the overall organization. So we can see they've got revenues and they've got expenses. So they lost $6,000. The budget was that they were supposed to make $300, just a little above break even. Every company can do this differently. Of course, it doesn't have to be GAAP. It's an internal report just for the managers within the company. So the format will vary from organization to organization. This company chooses to show last year as a comparison. The other thing I want to point out here, and you have to be very careful about this if you do this in Excel in the real world, is look at the column, the third column of figures there, where it shows the favorable or unfavorable variance. So it indicates favorable variance is a positive number, unfavorable is a negative. So positive, good, negative, bad. So in the case of revenue, I'm taking the revenue of $133,350 for dues minus $134,750. So we were unfavorable by $1,400 there. So I could have done actual minus budget to get that. But now when I go down into expenses, it's the other way. So now I've got 57,000 in actual spending minus the budget of 51,300. Now it's shown as a negative number because higher expenses, when my actual is higher than my budget, that's a bad thing or an unfavorable thing from an expense standpoint. So the formula is different in those two areas, and you have to be careful about that. I just mentioned that because I've gotten caught in that trap before. So I'm looking at this and I might say, okay, look at food and bar here. It's 46,000. And I look down below the food and bar expenses. It was 57,000. That looks like that segment of the business is losing money. That's not good. It's a bigger loss than what we anticipated it would be. So a lot of organizations will allow you to drill down and go into further detail. And the further detail might be something that's given to the manager of the food and bar area. So it looks like this. Now I've got the detail behind those summary figures. And I can see here that the problem appears to be with parties. It appears that we were losing money with parties, and that's the culprit of it. So the format's the same, but the detail is at a lower level. One of the things that I want to mention is that being under budget, having your expenses be less than what you had budgeted, in most cases is a good thing. It means you've done a good job of controlling money and spending it as if it were your money. It's not always a good thing. So back in that example I made earlier about engineering salaries increasing, well, if several months past the date at which you were supposed to hire those extra engineers, you still haven't done so, you would be under budget from your expenses on salaries for engineers, right? Well, that's not a good thing if that means that you don't have people doing the job that needs to get done for other parts of the organization to be able to do their part in reaching that strategic plan. So being under budget, being over budget is certainly something that needs to be investigated, but being under budget can also mean something that needs to be investigated, and that's important. So a little bit about the budgeting process. So the initiation of the budget is usually top management will give you some general parameters about the plans for the future. Usually the strategic planning process will have gone through and you'll have some idea about what's expected of you. Based upon that, you'll prepare a budget. There might be some overall criteria that the company issues, say, assume an average wage increase of 3.5% or something like that. But the manager will prepare their budget. Okay, well, this, given what I'm going to have to do in the upcoming year, this is what I'm going to need for money. So the management will pull that all together and take a look at that and see what the overall picture looks like in terms of whether they're going to meet the company's overall financial goals. When I've done this before, I think 9 times out of 10, the first time I pulled all of the different components together into the overall budget, we had a massive loss, okay, and you have to go through iterations of that because everybody asked for everything, that sort of a thing. So once it's been approved, the board or the senior management is going to tell the manager your budget's been approved, you can go forward. board. So then over the course of that year, they'll implement the budget through their daily decisions, through hiring people, spending money, incurring expenses, doing whatever it is that they need to do. And then there'll be monitoring that goes on. So those reports I showed you earlier, those budget performance reports, those will be issued to show you what the monthly variances are and that sort of thing. So it's very important in giving those reports that that the information is very timely. So you can't come to somebody in March and tell them about a problem they had in January. You kind of lose your credibility if you do that. So usually it's done within a couple of days of month end, that report is issued. The other thing that's really important is quality measures. So merely coming in under budget from an expense standpoint isn't enough if you've reduced the quality of the product in order to meet the budget, or reduce the quality of the service you provide to other portions of the company. Say you were in charge of the IT department in your company and you came in under budget by hiring fewer IT specialists that didn't have credentials, and so they weren't able to provide much help. Well, yeah, you came in under budget, but you didn't meet the quality measures that were required. So it's always, those two things have to go hand in hand. So some of the challenges for budgeting is it's a common evaluation tool. As I mentioned earlier, people are promoted and terminated based on how they do relative to budget from a spending problem or a spending perspective. And so that leads to several problems. So sometimes, and I've had this experience with salespeople, it's very common for salespeople to have compensation plans where they get an additional commission or a bonus commission if they go over their sales budget, that sort of thing, to incent them to sell more. Well, when you have a system like that, salespeople can tend to sandbag. They can say, oh, well, the economy is bad and this is bad and the competitors are fierce and all of this kind of stuff. And I think I sold this much this year, but I don't think I can do that much next year. And they kind of talk things down to lower the bar so they're more likely to go over it. Sometimes that's just because they want to look good. Sometimes it's because they'll make more money personally by doing that. So they have to be careful about that. You also have to be careful about excessive spending at year end. If it's a use it or lose it policy, sometimes people spend the money because they don't think they'll get it later. That especially happens in government spending. There could be a deferral of needed spending. So again, somebody could say, well, I'm over budget because I had to work some overtime with my staff, and so I'm going to make up for that by reducing the maintenance that I'm doing on the equipment, or that sort of thing, which isn't in the long run interest of the company. So that can happen. You can have people accelerating sales near end. So you're coming near the end of December and you're not up to budget. And so you contact customers that had shipments scheduled in January and ask them if you can ship them early. So you meet your budget. That doesn't really help you because then you're going to be short in January. So I worked for a company that fell into that trap, and they weren't going to meet budget, so they had a massive discounting program to offer customers a big reduction in price if they would take delivery before year end. And then they were virtually had no orders at all in January and February, which made the next year look bad. And so they were kind of addicted to this discounting scheme every December, which was completely dysfunctional. They would operate their whole factory at capacity and pay overtime the whole month of December and then lay everybody off in January and February. So that can lead to bad things. And then the opposite can happen. If a salesperson has already met their budget for the year, they can hang on to an order and submit it the next year to get a head start on next year. The term for that is called glove boxing, which goes back to when salespeople would drive around and get physical orders and they would stick them in the glove box of their car until the next year. So a little bit of trivia there for you. So budget ratcheting is how a lot of companies do things, which is they take the prior year and ratchet it up by a given percentage. There are disadvantages to that. It can be a disincentive for people to work hard if they know that it's only going to mean they'll have to do that much more the next year. So some solutions to that is you could not have budget targets. You could eliminate that and just kind of push people to do the best they can. Or you could have more frequent job rotations, so you're not trying to outdo yourself, but outdo the person who was before you. But in general, that's not the best way to go about doing budgets. Now, some companies take different approaches. Some companies do a top-down budget where the top management says this is where we want to go. We know enough about the whole company to know who has to spend what to get us where we need to. So basically, here is your budget, and we'll hold you to that. So the emphasis there is more about control than it is about decision management. The other way to do things, which is more popular now, is participatory budgeting, where the lower levels receive some general direction from upper management, but they provide the input to what the budget should be. The thinking here is that they're closest to the action, they're supervising that group of people, or they're managing the R&D function, or whatever the case is, so they're apt to make better decisions about how to accomplish what they need to do. That generally works better. Again, the downside here is that the lower levels don't necessarily have the big picture for the whole company. So like I mentioned earlier, you can get into that situation where you have to go through multiple iterations of the budget to get one that finally works. So short run versus long run, the problems that I mentioned earlier about managers delaying maintenance or delaying activities that incur short-term costs for long-term gain that make them look worse in a short-term perspective. The way to get around that problem is to do a combination of longer-term budgets and short-term budgets. A lot of companies marry that with their strategic planning effort. So you might do, as the book indicated, a 2, 5, or 10-year longer-term budget, the first year of which is what has the most detail, and the further out you get, the less detail there is. But that kind of keeps people focused on longer term. A couple of other budget topics I wanted to mention that were covered in the book. One are line item budgets. I haven't seen this in companies that I've worked for, but you may. The criteria there is that the spending on any particular line item is limited to the budget for that particular line item. So if you have a budget and there may be 5 different types of cost, one of which is salaries and another is supplies, if you save money on your supplies, you can't spend more money on your salaries. So you can't use savings in one area to offset overspending in another area. That is generally a mechanism to exert a bit more control over the spending further down in an organization, so it has its purpose. Another term is budget lapsing, which is use it or lose it, so unspent funds don't carry over to the next period. That generally has been the experience that I've had, is those types of systems. The key thing there is to make sure that there isn't excessive spending near the end of the budget term just to spend it because you have it. That isn't in the organization's best interest. There are 2 types of budgets that many people do. Most budgets are static budgets. So I'm in charge of R&D, and it says I can hire or I can employ 4 engineers, and I can spend this much on prototyping and this much on outside consultants and those sorts of things. That's kind of a fixed static budget. It's not tied to any kind of volume of activity. So it can work for the marketing department and for, like I mentioned, R&D, those kinds of departments. Could work for the accounting department, of course. A flexible budget is a budget that is tied to production levels. So it's split between variable and fixed cost. You can imagine if you were in charge of a budget area for, you were in charge of a manufacturing cell, and you were told you're going to make 1,000 picnic tables, but then the orders came in and you built 1,400 picnic tables. Well, of course, your spending is going to be greater than what the budget was because the budget was based on 1,000. So how do you properly evaluate if that manager did a good job on their spending control or not? Well, you really need a flexible budget to say, well, what should the spending have been at the level of 1,400 picnic tables? How did they do compared to that? So that's a really beneficial way to look at manufacturing in particular. The last thing I want to mention, I didn't get to that. Last thing I want to mention is some other topics here. I apologize, I was a slide ahead of myself in my notes. So zero-based budgeting is something that's used in many organizations where they want to avoid the trap of doing something because you've always done it. We have a reception staff because we've always had a reception staff. Well, that doesn't mean that you need a reception staff, right? So zero-based budgeting is looking at every bit of spending every year and justifying why it needs to be done. So it's pretty time consuming, but it's a good way to eliminate fat in an organization that it just kind of occurs because you've always done something, having to look at it fresh and justify it each time. The opposite of that is incremental budgeting, where you just have to justify the changes that you're going to make each year. One thing I strongly recommend is rolling budgeting, or some people call it continuous budgeting. That's where you add a period to the end of the budget each time you reach the end of a period. I used to do a rolling 4 quarters. So I had a January through December fiscal year. At the end of March, I would do a budget for January through March of the next year. So I had quarters 2, 3, 4, and quarter 1 of next year. So I always had a 12-month window in front of me that I could use for forecasting. So the reason that that's good is, especially in companies that are cyclical like mine was, I need to be looking out at cash flow forecasting so that I don't spend too much in the good periods and I have enough to live off of during the lower periods. So I can't make good decisions in November if I can't see out into next year. So doing a rolling budget gives you a continual view of what's coming down the pike. That's really important. Okay, here's the last part. So new approaches to budgeting. There are 2 different topics that the book proposed. The first is doing the budget in 2 distinct steps, where the first step is not with any money at all, but just operational terms. So how many widgets are we going to make? How many different kinds of widgets? What volume of widgets? Just strictly in unit terms. And then get agreement on that. And then the second step is to do a financial plan based on those operational plans. So that's one way of doing things, particularly in a manufacturing organization. The other one that I think holds a lot of merit is to simply do away with using budgets as a performance tool. So telling managers that they're not going to be judged on overspending or underspending, they're going to be judged on how they do their job, right? And we're going to compare them their actual results rather than against the budget. We're going to compare them against other units, either other units of the company that perform the same functions, or potentially other units from other companies that are similar to them. You can imagine if you had a business where you owned a variety of restaurants, you could compare each restaurant's performance to a benchmark for that type of restaurant. And so the objective is for the manager to run their restaurant better than other restaurants. The benefit here is I think you're making a comparison to something that can't necessarily be manipulated. A benchmark is what it is. And I think you end up with a more honest budget because it doesn't kind of coax people into or get them into making manipulations of the budget for their own benefit, which they might even do subconsciously. So I think that is a really, really good idea to take forward, which is kind of severing the link between performance evaluation and performance to budget. So that's the end. I've gone a little bit further than I intended on this one, but there'll just be one part to the lecture for this chapter. So as always, please call or send an email if you have any questions. Thank you.